everyone, and welcome to the series Beautiful Business powered by Xero. My name is Ange and I'm joined by my colleague Danielle, and we're here from the New Zealand Xero team. We just want to say thank you so much for taking the time to join us today. We really hope you find this to be a valuable and enriching experience. So here at Xero, we strongly believe in the value of bringing beautiful business to the farming and small business community, to assist you in making impactful decisions to unleash your business's full potential. And in today's session, we're going to be covering all things cash flow, such as ways you can manage it and keep track. So sit back, relax, and let's get those thinking caps on. So why are we here talking to you guys about cash flow? Well, let me tell you, cash flow is super important for any business, big or small, domestic or international. I vividly remember a friend telling me a while back that one of the first lessons she learned when she started her business was that profit and loss and balance sheets are fiction and cash flow is reality. And you know what? That really stuck with me, and I just believe it couldn't be truer. So let's consider this a Health 101 lesson for your business. We'll first go through what cash flow is and why it's important, and then we'll take you through some cures when your cash flow's under the weather. So cash flow represents the lifeblood of any business, and a positive cash flow is essential to the survival of your business. Sounds pretty important, right? So let's take it back to what cash flow really is. And the short answer is that it's the money coming into your business and the money going out of your business in a particular period of time. And so a positive cash flow just means you have more money coming in than you have leaving it. So that lets you pay for things such as your bills, wages, payments to the inland revenue, and other business expenses. Whereas a negative cash flow just means you have insufficient funds coming in to make those payments. If you want to think of it like a water tank, you have water coming in at the top and draining out at the bottom. So to keep your tank nice and full, you want more coming in than going out. Sounds too easy, right? Well, unfortunately, maintaining positive cash flows can be challenging at times for so many businesses. And when they run into problems around these, it can make it hard for them to pay their bills or meet their obligations in times, which in turn can jeopardize key relationships and with their working suppliers, or even result in a decrease in credit line from the bank or an increase in interest rates. Studies show that when businesses fail for financial reasons, poor cash flow is to blame, get this, at least 82% of the time. So now that we know what cash flow is, I'm going to pass it over to Danielle, who's going to go through the importance of it.
Thanks, Ange. It's really great to be here today. So as Ange already mentioned, cash really is the lifeblood of every business. A wise man once said, revenue is vanity, profit is sanity, but cash is reality. It's really a very simple equation. If you have no cash in your account and you have no means for getting extra cash into your business will stop. It's as simple as that. Managing cash flow is all about understanding when cash is coming into your business, and I'll talk about those sources in a moment, understanding and being able to schedule and plan for when cash is going out of your business, and having a plan in place for when you have less cash than you need. So it's about how to get more into your hands when faster. It's super important, and we see it as the financial backbone of a business. So as Andrew already mentioned, it's a simple equation. It's cash inflow minus cash outflow, and it's as simple as that. And when I talk about cash inflows, it's from various sources. It might be from cash sales of goods and services. It might be the cash coming in from your customers when they are paying invoices on account. You might have taken out a loan from the bank, and that cash is coming into your business. It might be revenue from interest, savings or investments, that kind of thing. And that cash is what you then need to go off and pay all of your bills for your business, such as purchase of raw materials, such as stock, all of your operating costs, rent, wages and salaries, purchase of assets for your business. We believe that cash flow management is really the foundational backbone of your business. And once you understand the cash position of your business, you understand when money is coming in, when it needs to go out, and what the plan is going to be for when things aren't so rosy, then you can focus on other parts of your business, which are things like growing your business. You can take your eye off of just being solely focused on cash flow and make sure that you can make decisions around, growth and margins and all the rest of that. So now that we understand the importance of cash flow, I'm now going to talk to you about a few ways that you can help to maintain and manage your healthy cash flow.
So let's start with getting paid. So that's how to improve your cash inflow. So with this, it's great to start thinking about your liquid assets. And your liquid assets are those assets in your business that you can quickly convert into cash, kind of like inventory, for example. Also, how often are you checking in with your customers that haven't been paying you recently? Guys, now is a great time to pick up the phone, check in with your customers, and discuss payment terms that work for the both of you. There are also other ways to encourage getting paid faster, such as offering a small discount for early payment. So yeah, offer a small discount for early payment, or even structure the payment from your customers with an upfront deposit before you complete the job. Or let's just say it's a longer term agreement. You could schedule your customer to pay you in installments throughout that period instead of waiting right till the end. And now I want you to ask yourself the question, how efficient is your business when it comes to invoicing your customers? Do you quickly fire off the invoice straight after you've completed the job? Or do you sometimes wait a few days, weeks, or even months? Guys, invoicing efficiently can make all the difference when it comes to cash flow. And making sure that your invoices are easy to read, like having your amounts, due dates, payment terms, and bank account all clearly stated and in bold can make all the difference. So now let's move tracks onto inventory. Okay, so there's no surprises. Inventory is costly. It costs money to manage it, and it costs money to store it. Are there leaner ways that your business could manage its inventory? And when was the last time you performed a stock take? So when was the last time you performed a stock take to really identify what's on hand? You might have some obsolete stock lying around that you could quickly sell at a discount. The same logic applies to other assets around your business. You might have other assets that are lying around that you might have bought a while back and they were nice to have, but are now no longer crucial in the operations of your business. I guess think of it like a little Marie Kondo cleanse for your business. And now, as easy as it sounds, it's important to keep a close eye on who owes you and when those invoices are due. So you can actually use an accounts receivable aging report to keep track of this. And this pretty much just lists out your customers who owe you, the amounts that are owed, and when those invoices are due. So you can see whether invoices are overdue 30 days, 2 months, 3 months, or even longer. So you know which customers you need to focus your chasing efforts on. So just considering a few options that I've gone through can help you get cash in your door quicker along the way.
Thanks, Ange. Now, Ange has talked about how you can free up cash flow when you're looking at liquid assets within your business. But there are some other things that you really should consider. And we sort of talk about cutting down non-critical expenses, non-essential expenses within your business. Now, look, there's no two ways about it. You have to pay your bills on time, and we would never say anything else. Now, why? Because it builds trust with your suppliers, it builds the relationship, and it's just essential. It's good business practice. But when was the last time that you had a constructive discussion with your suppliers around their payment terms, any discounts available? When businesses start out, they're new, or you've started out with a new supplier, credit terms tend to be quite tight. They don't know you and they don't want to put their business at risk. But as that relationship develops, it might be worth a conversation to say, hey, we've been doing business for a few years now, you know that I'm a good payer. Is there any opportunity to negotiate those terms, whether that's extending payment terms or whether it's getting a discount through from those suppliers for prompt payment or early payment? I mean, it might well be a win-win for you and your suppliers if they can get cash in a bit earlier and you can receive a discount. Now, one of the other things that we see small businesses do a lot is they get bills in from their suppliers and they pay them immediately. And when you ask them why they do that, they say, I don't like to be in debt. Well, that's fantastic, but unless your customers are also paying you as soon as they receive an invoice from you, you are likely to get yourself into a cash flow hole at some point. So what I would suggest is really making use of the terms that your suppliers provide you with. And if you are able to negotiate terms with your suppliers, have, as Ange said, have the conversation with your customers and make sure that the terms are working for both of you too. And then there's that other conversation, which is, is it time to go out and have a look at sourcing other suppliers to see if you can get the same goods, similar goods at a better price. Competition's a good thing. People vying for business out there, go out and see what you can do for your business. So talking about bills, we've then got other non-essential expenses. Now, when business is going well and we've got discretionary cash available, it's quite easy to spend money, I find. But now is the time when times are a bit tight to really be critical and cut out anything that's not adding value to your business. And lots of small changes can make quite a big difference to your cash flow. Now, you don't have to do this on your own. Your accountant or bookkeeper, they're professionals, and they can really help you to do this. They can sit down, critically evaluate your profit and loss, and identify costs within the business that you could strip out without actually minimising or reducing your customer relationships. It's time to start to plan for uncertainty, and this is a really good starting point. So with the recent unprecedented events that COVID-19 have brought to all of us, the New Zealand government rolled out some legislative changes to help support small business cash flow. And a number of those changes includes tax relief offered by Inland Revenue, New Zealand's tax agency. So Ange and I are going to talk through a number of tax relief options available for small businesses. Now, your business might have been very lucky and might not have been significantly affected by COVID-19. However, just be aware that these changes are available and open to all small businesses in New Zealand. But please note, we're not offering advice, we're merely providing general information. Please speak with Inland Revenue or your accountant or bookkeeper to understand what options are available, get more information, and decide what's best for your business. But really, from our perspective, it's about giving you information to give you that knowledge and understanding to have those conversations with your advisors. So back over to you, Ange.
Thanks, Danielle. So for those small businesses making a profit for at least the last year, you should all be familiar with provisional tax. So provisional tax is that income tax payable on your current year profit for the financial year. And it's paid in instalments throughout the year to relieve you of needing to pay a large lump sum right at the end. So the government have implemented some changes around provisional tax, and I'll take you through them now. So firstly, they've increased the provisional tax threshold from $2,500 to $5,000. This just means your business only needs to pay provisional tax if your tax payable is expected to be greater than $5,000 at the end of this 2021 financial year. And this is a permanent change kicking in from this 2020 to 2021 financial year and onwards. And it's really just there to help, small businesses retain cash for that little bit longer and also help them lower their compliance costs. So now secondly, if you believe your business has overpaid provisional tax, the Inland Revenue have actually advised that they can arrange early refunds. So make sure to check that out if you think it's applicable to you. But on the flip side, if you want to continue paying in instalments, you can actually make voluntary payments to the Inland Revenue. Or why not chuck that money in a separate bank account and keep making payments there? This just means you have the cash there in the bank account, and when it comes to your tax bill at the end of the year, you've got the funds to pay it, and there's no surprises. So if you want to know more about these provisional tax changes implemented by the government, make sure to reach out to your accountant or bookkeeper for more information. Okay, so now the next change relates to low value assets, and I'm so excited about it. So previously, when your business bought assets such as plant and equipment, machinery, office equipment, you name it, if it was over $500, you would need to record that as an asset and were only able to claim the depreciation. Thankfully, the Inland Revenue have changed their position over this, and they've actually now temporarily lifted this threshold from $500 to $5,000. And this is from the 17th of March this year to the 16th of March next year. So this just means your business can purchase assets up to that value of $5,000 and claim that full amount as a tax deduction. So this means it'll increase your expenses, which will in turn decrease your profit, but that'll reduce the amount of tax you need to pay. So to give you an example, let's say your business bought a new cage trailer last week and it cost you $2,000. So now you can claim that full value of that trailer as it was purchased before the 16th of March next year. So clearly you can see you get instant tax savings, so make sure to take advantage of it if you are about to buy assets. And just remember, this is only a temporary increase. However, from the 17th of March next year, the Inland Revenue have advised that they will permanently be lifting this threshold to $1,000 for any assets purchased going forwards.
You can tell we're accountants when we get excited about tax changes. For those of you who own commercial or industrial buildings, you'll be really pleased to hear that depreciation is making a comeback for 2021. So Inland Revenue has announced that they're reintroducing depreciation deductions for non-residential buildings, and that's kicked in already from the 1st of April 2020. They've also announced that the depreciation rate for diminishing value will be 2% and 1.5% for straight line depreciation. So for example, if you've got a factory that you own, you've got a value in the books of $4 million, you use it to generate revenue for your business and run your operations, great, it's a commercial building. You can start depreciating for this 2021 tax year. Now, how does that impact cash flow? Well, depreciation is a deductible expense that will reduce your taxable income and the tax you need to pay, which is great. So the government have implemented these changes to really support small business recovery. We know it's been very difficult for small business and will probably continue for some time. So our role here is really to give you the information, to give you some insight, to start those conversations with your advisors about what's available for your business, because that can make all the difference to your cash flow. So really, the last piece of the puzzle is how do you get insights over your business cash flow? How do you get visibility over how you're tracking? So Xero is a fantastic platform, and we have some great tools within Xero which can really help you to do this. And the two tools that I want to talk through today are called the short-term cash flow feature and the cash in, cash out graph. So let's take a look at each of these now. So we've recently released a pilot feature in Xero, which we call the short-term cash flow tool. So it's a dashboard style tool, which is really there to help you view and manage your cash flow better. So it helps you to predict business cash flow for the next 7 to 30 days. So it's a bit of a short-term tool. It's calculated on the balance of your bank accounts and upcoming bills and invoices that are loaded into Xero. Now, clearly, it's more accurate when your reconciliation is up to date, okay? Because, invoices have been paid, blah, blah, blah. And it then gives you a really realistic view of your operations. So the great news is, if Ange rings me and says, Danielle, I actually can't pay that invoice today, I'll be paying it in 10 days' time, I can update the dates in Xero and I will be able to see the real-time impact of that delayed payment coming through and how that will affect my cash position, which is great. And just an inside scoop, our Xero team is working on bringing cash predictions into the short-term cash flow feature. So this means that the feature will look for repeating patterns in your business's bank transactions and will also pull this information through into the forecast as well, which is fantastic. Now the next feature is the cash in, cash out graph. And even though it sits right on the Xero dashboard, it's probably one you've overlooked, to be honest. What is it? It's a graph that shows you a snapshot of cash flow month to month, and it's historical. It looks backward. So it's really quite simple. It's a bar graph. The blue bars show money received, and the grey bars show money paid. And if you hover over the graphs for a specific month, you'll see the actual cash amounts coming up. So it gives you a really clear, easy visual of the difference between cash in and cash out for your business. So how can you use it? Well, because it's historical, it's been, right? But it allows you to identify trends or areas of concern. So for example, March might be the best month of the year for me. I sell tons of stuff and I make lots of profit. But when I look at the graph, it shows that I was in a negative cash flow position. That would indicate to me that I need to have a look at what's gone wrong there and make sure that I have planned for that not to happen again going forward. So it allows you to make necessary business decisions to do things better next time. So I'm sure you'll agree, it's never been easier to keep track of and assess how your business is managing your cash flow using just these two simple features right within Xero. Ange.
Awesome, thanks Danielle. So guys, now it's time to talk about the invoicing side of things. So we know for most businesses, invoicing is a crucial element to the operations of your business. However, we understand and appreciate that not all of you may invoice in your line of business. So if it's not relevant to you, feel free to drop off, but we really look forward to seeing you at our next Field Day session we're running. Back to you, Dee.
Thanks, Ange. So Ange mentioned earlier that efficient invoicing is really crucial in driving good cash flow management. So hopefully there's no one out there who is completing work on the 2nd of the month and waiting till the end of the month to invoice. Times have changed, get with the program. So once you've sent the invoice, that's fantastic, but it's quite another thing to actually get the money into your business. It actually can be quite tricky. Thankfully, we have some really great ways, great tools within Xero to help streamline getting paid faster. There's two that I want to mention today. One is invoice reminders and one is setting up online invoice payments. So let's take a look at each of these now. So invoice reminders really take away the pressure of having to chase customers for payment. It's around automating the process for chasing customer payments. So when you enable invoice reminders within Xero, what it does is it sets up and emails automatically the customers when their invoices are overdue. So at the moment in Xero, the default position is it will send an email when they're 7 days overdue, 14 days overdue, and 21 days overdue. But that is fully customisable. You can also send a reminder to your customers when, just say, it's 2 days out from the payment date and say, hey, just a reminder, payment is due soon. The emails are also fully customisable. And what it means is once you've switched them on directly from the invoice dashboard, the system will do the chasing for you. You don't need to be doing it. So the key with invoice reminders really is that you need to be reconciling your bank accounts regularly. So not monthly, like we used to in the old days. You need to be reconciling daily, okay? Because what will happen if you don't is your customers that have already paid your bill will receive an email from you saying, hey, looking forward to your payment, and that's not good for relationships. So the idea of using this is that you'll spend less time chasing your customers, let the system do the work for you, and you can spend more time either on your business or spending time with loved ones maybe. So next up, we've also got an online invoice payment feature. So you might have switched on your invoice reminders, but you want another tool in your arsenal to really drive payments. So you can, right within Xero, from our payment services screen, you can click the Get Started button and you just follow the prompts to set up the connection. So when you're connected to a payment service and our preferred providers are Stripe or Go Cardless, a Pay Now button will appear on your customer's online invoice. So you send the invoice out to them, Pay Now button is right there, and they can pay the invoice directly right from the invoice using their debit card, their credit card, or using direct debit if you're with Go Cardless. So it saves your customers having to log into internet banking, copy over your bank account details, potentially put the wrong number in, forget to pay. I know that when I get an invoice and I have to pay it manually, I do often forget, it gets lost in the emails. So this is a way of having fewer excuses come in from your customers as to why they're paying you late. So I'm sure you can see these tools are really useful. They're right within Xero, and they are there for you to use to help drive and get business cash into your business faster. Back to you, Ange.
Awesome. So yeah, if you want to know more about online invoice payments, make sure to reach out to your advisor, accountant, or bookkeeper, and they'll be able to help you with this. Now, some of you may have heard about electronic invoicing, e-invoicing for short. And guys, it is the brand spanking new and smarter way of invoicing. So e-invoicing is the direct exchange of invoices between the sellers and buyers' accounting systems. And through a mutually connecting network called PEPL, it allows the buyers and sellers' accounting systems to pretty much speak to each other, even if they're completely different systems. Kind of similar to the way that users of different mobile phone networks can speak to each other, like Vodafone and
Spark.
Exactly. So traditionally, businesses would need to email, post, or even scan an invoice to their customers, have their customer upload it into their accounting system, and then make the payment. Clearly, this was a time-consuming process and often left room for errors. Like, what if the invoice wasn't received? Or what if it was received but not entered? Or let's just say, what if it was entered but entered incorrectly? Guys, too many what ifs, never good for cash flow. Whereas with e-invoicing, businesses across New Zealand no longer need to generate paper-based or PDF invoices that need to be printed, posted, or emailed. And buyers no longer need to manually enter those into their accounting systems. Instead, an invoice that is raised in the seller's accounting system will automatically appear as a draft bill in the buyer's accounting system. No manual intervention needed. So as you can see, that automating of the sending and receiving of invoices really removes friction. It also speeds up processing and also reduces the amount of data entry errors. So it's a win-win. Think how much time you could really save just by implementing e-invoicing and really focus on the operations of your business. And think how much faster that cash in your water tank can be filled much quicker than before. So with e-invoicing, you do need an NZBN number, so that's a New Zealand business number, and you'll need that of everyone that you want to send an e-invoice to. But you can fully integrate that into your procurement or accounting systems, so it's all good. And just stay tuned with the updates over e-invoicing because it's going to be fully rolled out in the next few months. So guys, now it's time to prepare your business for e-invoicing. Pick up the phone, talk to your accountant, talk to your bookkeeper, or even just check out the NZBN website for more details. It's time to take advantage of this new phase of invoicing. Okay, so that brings us to the end of that Cash Flow Health 101 lesson for your business. And just remember, to thrive, you really need to be closer to your numbers and know how your business is operating, understanding what's working and what's not. And taking the time to focus on this can make all the difference when it comes to your cash flow. And embracing those simple changes like Danielle mentioned before, such as switching on invoice reminders from your Xero dashboard, or even negotiating different payment terms with your suppliers can make a big difference. And now to stress the importance of cash flow, yet once again, I'm going to end on a quote from Michael Dell, CEO and co-founder of Dell Technologies. We were always focused on our profit and loss statement, but cash flow was not a regularly discussed topic. It was as if we were driving along watching only the speedometer, when in fact we were running out of gas.
Thanks, Ange. I love that quote. It really resonates. Don't just look at your profit, look at your cash flow. It's more important. Thank you all for tuning in today. We hope you have taken away some really useful insights, and we look forward to seeing you at the next session in our series, Beautiful Business Powered by Xero. For now, take care, be kind, and look after one another. Kia kaha.